Well, welcome everyone to our live Q&A session. My name is Natalie and I'm here with Dimitri. Today we will be answering all of your self-directed IRA and solo 401k questions. We do have a lot of questions that were submitted, so we are going to have to jump right into this. If you do have additional questions that come up to mind during the session, go ahead and type them up in the Q&A chat area. We will make our best effort to answer all those questions today. Alternatively, we would like to have you register for our next Q&A session, which will be on Monday, March 27th at 11 a.m. So you can make note of your question when you register for our next Q&A, and you can submit your question there. But before we get started, I would love to give a brief introduction about Dimitri. Dimitri Fomichenko is the founder and president of Sense Financial LLC, which is a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. He began his career back in 2000 in financial planning and real estate investing, and he is a licensed California real estate broker, a real estate investor, and a private lender. And over the years, he has taught hundreds of investment financial planning seminars and mentored thousands of investors. So welcome, Dimitri. I'm glad that you are able to answer all of the questions that were submitted.
Sure. Thank you, Natalie. And just a couple of housekeeping items. We want to make sure that you guys can hear us well and you can see the screen. So if you can maybe give a thumb up or just a quick chat to let us know that sound and video is good. Okay, cool. Thank you. All right, well, let's jump in.
So our first question is from Judith. Is it mandatory to take withholding tax when you take an RMD from your solo 401k?
Good question, Judith. When you take distribution, whether it is a RMD or just a normal distribution, you are required to take 20% withholding and send that to the IRS. We do have an article in the knowledge base that details the process with all the specifics. So the answer is yes.
Next question is from Scott. Can I have a solo 401k with a sole proprietorship and then transfer it to an LLC later?
Good question. So what you're asking, Scott, is about changing the plan sponsors. Solo 401k plan is not for everyone. In order to qualify for a solo 401k, you must have a sponsor of the 401k plan, and that can be an individual as a sole proprietor, anybody who's self-employed, or if you have an entity, then entity can be the sponsor of the 401k plan. So in this case, you're basically maybe your business is growing and you're incorporating or setting up an LLC or S corp. That's actually quite common. People do that. So in this case, your 401k plan itself will not be affected, but the plan will have to be amended to indicate change of the plan sponsor. That's part of the services that we offer. It's included. There's no extra cost for that. All you have to do is reach out to us, let us know that you are changing the plan sponsor. In fact, you're required to do that. And then we'll issue an amendment to your plan. And it actually can happen the other way around. We've done it for other clients who they had a corporation and they're maybe downsizing. Maybe they're getting closer to the retirement. They're getting ready to kind of wind down their business and they want to close the entity because they don't want to deal with the corporate taxes and things like that. So they just become sole proprietor. It can be switched the other way as well. But yes, good question.
Margaret is asking, are there any ways to take out a loan from my self-directed IRA?
The short answer is no, and that's pretty much, there is not much to expand on that. There is no possibility to take a loan from an IRA. It doesn't exist. The only way to access IRA funds is to take a distribution. Distribution from an IRA is subject to taxes. Roth IRA contributions can be pulled out tax-free, but the qualified distributions, you have to wait for them to meet the criteria. And also, if you do premature distribution, you will be assessed penalties. So that's the downside of the IRA, and that's a great advantage of the 401k, because you can tap into your retirement funds anytime for any reason, and have access to that participant loan up to $50,000 or 50% of the balance, whichever is less. And it's like you have your own bank that you control and you can tap into, and no one can turn you down on that.
Next question is from Amitabh. If I lost a big chunk of solo 401k investments, how do I report it to the IRS?
Well, you don't specifically report the loss on the investment or a gain on the investment. It's remember, this is an unrealized loss or unrealized gain, and you don't report those because it is inside of a qualified retirement plan. And maybe you will understand it better if you use just a conventional retirement account and you buy in some mutual funds or stocks, and then you are maybe you gain a significant amount or you lost, which is not uncommon. I mean, just I spoke with somebody yesterday who had $100,000, and that $100,000 in a matter of a few months down to $81,000, so about 20% loss. Well, it is still in his IRA. It's not a taxable event, and so there is no necessarily tax consequences. So the loss is a loss inside of a retirement account, whether it's a loss from purchase of a stock or loss from a real estate or any other investment. So it's not reportable. But with the solo 401k, you are required to submit an annual report to the IRS, and that report includes you have to report total plan assets. So it's not reported directly, but it will be included in the total plan asset valuation as of 12/31. But you don't have to report it directly, specifically.
Milad, best way to open accounts under 401k trust?
Milad, most clients come to us because they want to invest in alternative assets, and alternative assets do require you need to have access to your funds, and the best way to do that is with the checking account. We do have a couple of banks that we recommend. Solera is our preferred bank, and we do have detailed instructions how to open account for your solo 401k trust. You can open a checking account online. It's very quick and simple process, and all you have to do is just go to the client portal, navigate to the setup section, and then click on step 2, which is banking. And we have detailed instructions there for opening an account for your 401k trust.
Next question is from Justin. Is it possible to switch the name from one solo or one 401k to another if the original business isn't operating?
I think this question might be related to the one that I answered just a few minutes ago about changing the entity. So if you have established a 401k plan for a business A, which is also not uncommon, it happens. And this business no longer in existence. You terminated that business venture, and in order to maintain a 401k plan, if you have another business, or even if you're just a sole proprietor, then the plan documents can be amended to indicate the change of the plan sponsor, which will enable you to continue on with the 401k. The plan itself will not be affected, and the investments of the plan will not be affected, but the plan needs to be amended to reflect a change in the sponsor of the 401k plan.
Danny is asking about end of the year statements to IRS.
Danny, I don't know what you have, whether it's an IRA or 401k, because the requirements vary for each of those plans. So, but let me answer this question with both perspectives. If it is an IRA, then your custodian will take care of all the reporting. You are required to provide the value of the LLC, if it's checkbook IRA, to your custodian once a year in December. They will reach out to you. We also will reach out to you to remind you. And you simply have to provide them the value of the LLC, just one single number. You have to take all of the assets that are inside of the LLC, add them all up, and just give that single number to the custodian. Then custodian submit Form 5498 to the IRS. That's how the IRA reporting is done. For the 401k, it is different, and reporting is actually not required until you reach $250,000. That's the magic number in total plan assets. So remember that that's not the total value necessarily of the 401k, but the total plan assets, because you may have, and that's one misconception. Let's say you own a property that is worth $300,000 in your 401k, and you put $100,000 down, and you finance $200,000 with a non-recourse loan. So the actual value of the 401k is $100,000 only, because that's how much equity you have in that property. But the total plan assets, $300,000. So you are over the threshold, and you're required to submit annual reporting using Form 5500 EZ. This form is we provide detailed instructions how to complete this form. It's actually pretty simple and straightforward form. There is only 2 pages that you need to complete. We tell you exactly how to answer each question. The only thing that you have to do on your own is to enter the plan assets number. So again, in this case, you will be required to submit that report. But if you are under $250,000 in plan assets, you are not required to do so. But we do recommend you do it anyways. Even you start with just $50,000 in your solo 401k. It's a good practice, because this will enable you to take advantage of the statute of limitations. And number 2 is you get the record with the IRS, and you get in habit of filing this form. So when you actually will be required, you're not going to be risking forgetting that. Although we do send reminders when that form is due. But good question.
David is asking about looking to understand the process to convert to Roth IRA and general information gathering.
The question is a little bit unclear. Do you have a traditional IRA that you're looking to convert to a Roth IRA, or do you have a Roth IRA in place and you wish to convert that to a self-directed Roth IRA? So if you already have a self-directed traditional IRA and you want to convert that to a Roth, that will be a taxable event. You can do it at once. That will be simple. If you're converting entire balance, that's pretty simple. The conversion is a taxable event, so there will be tax consequences. You do want to check with your CPA on that. But oftentimes people do it in steps, and that then will be challenging for a self-directed Roth IRA. But it's best that you reach out directly to us. I'm happy to speak with you directly and get some more details about your situation and give you the guidance you need.
Next question is from Jeffrey. SD IRA as an LP in a multifamily property that is used recourse debt. Is that prohibited?
Well, Jeffrey, good question. And probably most of you who are on the call aware that when you can finance investment inside of your self-directed IRA or 401k, but you're not allowed to provide a personal guarantee. Therefore, the loan must be non-recourse. Now, if you're buying into a multifamily as a limited partner, and one of the general partners is just guaranteeing the loan, which is a recourse, then that's fine. As long as you personally don't guarantee the loan, then it will not be prohibited. I'm not sure how common is this and how likely is this, but technically it will not be prohibited. But the bigger question is that how likely that's going to happen, which personally I don't think it's very likely.
Next question is from B. Holding foreign stocks in a self-directed IRA LLC. Is there additional tax reporting the LLC manager needs to report?
Good question. This is, I don't believe there is any additional tax, because with your self-directed IRA, you can invest in virtually anything. You can invest in stocks domestically here or stocks, foreign stocks. So I don't believe there is, but you may want to clarify this with your CPA, because this is a tax question, and I'm not a CPA. I cannot give you tax advice. I don't believe it is, but yeah, double check with your CPA.
Jacqueline is asking, when it comes to financing a purchase, can you utilize owner financing?
Absolutely, Jacqueline. You can, and that's happens. And if you're able to acquire a deal and you can negotiate seller financing, you certainly can do that. Just again, remember, when you invest in using your IRA or 401k, you're not allowed to provide a personal guarantee. So make sure that this owner financing, there is a clause in it that it is a non-recourse. You're not allowed to provide a personal guarantee on that. So make sure it's non-recourse, and otherwise you certainly can.
Next question is from Luke. Compare and contrast tax considerations using self-directed IRA when investing in real estate with debt.
Luke, good question. It's probably a little bit beyond this Q&A, because it's a more involved question, and again, it's a tax question, and I'm not a CPA. I can only give you a general overview, but generally speaking, again, when you use your IRA to invest in real estate and you use leverage, a portion of the income that comes from the leveraged portion of the property will be subject to what's called the UBIT, or unrelated business income tax. And so, for example, if you buying a property for $100,000, you put 50% down, and then you finance the rest, you get a non-recourse loan for $50,000, then technically half of the income is derived from a portion that your IRA doesn't own directly. The leverage being used to acquire that portion of the property. And that portion of the income will be subject to UBIT tax. But remember, the first $1,000 is exempt from that. And then you can also, in this case, if it's 50-50 leverage, then you can deduct half of the expenses, your property taxes, insurance, property management fees, all the repairs, and mortgage interest. So you can deduct half of the expenses. So there is you need to do some calculation. In this case, then you will be required to file Form 990T. That's what the UBIT tax is reported. And also to mention the difference between an IRA and a 401k. If you were to do this inside of a self-directed solo 401k, it will be exempt from the UBIT on leveraged real estate. So there will not be any consequences, tax consequences on using leverage in a 401k. That's another advantage. So if you're eligible for solo 401k, certainly should look into that alternative. But again, if you're using an IRA and you're using that, then you do want to speak with your CPA to understand the reporting requirements and consequences.
Next question is from Sam. Explain how to repay a non-recourse loan for Roth 401k to avoid to mix pre with after tax money.
Sam, I think it's a good question, but it's a little bit unclear. From this question, I don't fully understand what it is that you're doing. I can probably guess, and I'm guessing that maybe you used money in your 401k, you pulled the money from the Roth bucket, and you pulled the pre-tax money to acquire a property inside of your 401k. Well, if that is the case, then you have to keep the same ratio for Roth and the pre-tax. It's like, if you and I were to partner on a property, right? I used a portion of my funds and you use portion of your funds, then we will keep track of initially when we acquired the property, how much money each contribute, and then all the income and expense will be split. So the same way here. And the best way to do that, Sam, is to use operating account. You can set up a new account just for that property. You can fund it. Let's say you're using 50-50 funds from your Roth and then from your pre-tax fund. So you put $50,000 from your Roth 401k and then another $50,000 from your pre-tax account. And then you use that account to fund the investment. And then all of the income is going back into that account and all of the expenses are being paid from that account. So this way, you don't have to split every single item on the balance sheet. So you're using a single account, and then maybe once a year or however after you decide, then you can distribute the profits into respective accounts. But that's how you do it. I hope I answered that question for you, but feel free to reach out to me directly for further clarification.
Next question is from Lisa. How to invest or trade in crypto?
Lisa, good question. In last few years, crypto investing became more and more popular. And you can do that with using your solo 401k plan, just like you can use your solo 401k plan to invest in stocks or mutual funds. You need a brokerage account. Well, to invest in crypto, you need an exchange account. So there are several exchanges that will allow you to open an account for your solo 401k trust. And we do have an article again that outlines the details. So what you want to do is go to the client portal, go to the knowledge base and just type in the search crypto or cryptocurrency. And you will get several articles that give you information and guidance how to do that.
Trang is asking, do we have to report how we invest the money each year?
Trang, good question. If you use a checkbook IRA or a solo 401k, you don't have to report. You as the administrator of your 401k trust or as the manager of the LLC that your IRA owns, you keep all the records, you keep track of everything, but I don't really have anything to add to what I said earlier is that there is an annual reporting, and the only thing that you have to report is the total value or total assets if it's for a 401k. So you have to provide that reporting at the end of the year, but you don't have to report specifically which investments you made, how much gain you generated, how much income or loss you generated, just a single number at the end of the year. Now, if unlikely event you get audited and questions will be asked and you'll need to provide the answers. That's why you want to keep all the records in your possession and that you can go back and answer, but no specific reporting is needed.
Okay, next question is from David. What are the most common mistakes people make in their solo 401k?
Good question, David. I'm not sure if I prepared to give you a list of the common mistakes, but I think I can summarize that in a single answer for you. David, I think the most common mistake people make is that they do something without, and they're not sure, and then without clarifying or without asking. So, David, my answer to you and everyone who listens, if you just remember one thing from this session, remember this, that if you're not sure about something, you contact us and ask a question. All my clients, they have access to my email. You have my direct number that you can actually text me. So it takes literally less than a minute to send a text message to me, and usually you get a response from me pretty quickly on a text message if it's a quick question. So this way, then you'll know the answer. But don't make a mistake that you do something and then you realize, well, was that allowed or not? And then you ask a question, because you probably by then may have committed a prohibited transaction. So you want to avoid that. Again, don't make a mistake doing something that you're not sure. If you're not sure, ask. That's my advice to you.
Dominic is asking, regarding the Roth IRA trust, can I trust the Solera bank you use? And this is a question that his CPA asks.
Well, you absolutely may trust Solera. Solera is, we use them as a custodian for an IRA, and they are IRS approved custodian, registered with the IRS. But also remember this, that as a custodian, they're a passive custodian, and they're actually not holding, they're holding an IRA with a single asset, and that asset is either an LLC or a trust, depending on which structure that you're using. So all of the assets of the IRA will be in the checking account. Now, again, if it's Solera as a custodian, Solera will host the checking account as well, and that's what the funds will be under your control. Now, this is something, let me spend a little bit more time in light of the recent turmoil in the banking industry. As most of you probably aware, a couple of large banks went under just over the last several days. I'm not going to go into reasons why. They're actually not very difficult to discern, but the bottom line to all of you guys, whether you have a checkbook IRA, LLC, or a trust, and you have a checking account for that, or you have a solo 401k, or even it comes to your personal accounts, you want to make sure that your funds are protected, and you can get that protection up to $150,000 FDIC insurance. FDIC insures the cash in the bank in your Solera bank account. If you have more than that, there is actually a way to spread that over and get even with the single bank account. You want to contact your bank to inquire that, or simply spread the cash into another bank, open an account at another bank. But I just can't imagine that that's going to be the case for most people. Most people don't keep that kind of a cash in the checking account. So if you have money, you probably will be investing those funds. You want to put that to use. It's not, it's no use to keep the cash, because again, of the inflation, your money is losing its purchasing power. But again, Solera Bank is FDIC insured, and your cash is protected there up to $250,000. If you have more, then talk to the bank about how you can get the protection on the entire balance.
Okay, Mano is asking, what are the do's and don'ts in using solo 401k funds when buying real estate?
Good question, Mano. So again, what the do's and don'ts, it comes to prohibited transaction. And just to remind you that most prohibited transactions occur when disqualified person gets personally involved in the transaction. So you can use your solo 401k to invest in virtually anything except collectibles. So when buying real estate, you can certainly do that. But you want to make sure that the transaction of the 401k does not have any involvement of a disqualified person. And disqualified person will be yourself, your spouse, your kids, grandkids, and their spouses, and your parents and grandparents. So a vertical line. So you want to make sure that family members are not part of that transaction. To give you an example, if you buy a rental property in your 401k, your parents or children cannot stay in that property. You cannot stay in that property yourself. You cannot do any work on the property yourself. So everything has to be outsourced. Again, just remember arm's length transaction. But otherwise, you control it. You get to say who's going to do the repair on the property, what kind of improvements you're going to do to the property. You get to say, whether this tenant, you will approve it for this tenant or not. But one example is I'd like to use is a blue collar work versus a white collar worker, right? As a white collar worker, it's someone who's actually in a white shirt and a tie in the office, doing the kind of administrative type of work. So you will be on the phone, you're doing the paperwork, versus a blue collar, somebody who's actually working on the factory floor with their hands. So you don't want to be working on the property, doing repairs, changing door locks, painting the property, things like that. You want to outsource that, but you certainly can do the administrative functions. So I hope this helps. And again, to remind you, Mano, and everyone, that if you're not sure about something, ask.
Next question is from Cliff. The rules for contribution limits if a salaried employee at a company with a 401k.
Cliff, good question. If you work for a company that offers you a 401k and you participating in that, and you also have a side business or a side gig, and you also have a solo 401k for that side gig, then the contribution limits will be affected, because with the solo 401k, there is two components for contributions. You contribute as an employee of your business, but you also a business owner, so you get to contribute as a business. And as the employee, the 401k rules dictate that the contribution limit, which is for this year $22,500, plus catch up for those who are over 50. This limit is subject to a single limit for all the plans that you may be part of. For example, if you're contributing $10,000 to your employer 401k, then you only have $12,500 for a total of $22,500 to contribute in your solo 401k. So you cannot exceed the $22,500. That's the total. You can put the max in your employer 401k. If you choose to, you can put the max into your solo 401k. You can split them any way you want, but you cannot exceed the $22,500. However, on top of that, solo 401k has a profit sharing limit, and it has a total limit. So you can still contribute significantly more, over 60,000 actually. Even if you maximize the employee deferral limit at your work 401k, you can still put $60,000 as a profit sharing, assuming that you have enough income to support that contribution. So that contribution limit for a solo 401k, the total limit, is independent of your 401k elsewhere. Hope this helps.
Next question is from George. If I'm over 59 and a half years, can I do an in-kind distribution of a home in an IRA LLC in a period of 5 years?
Yes, George. If you are over 59 and a half or not, the age is really irrelevant here. Well, it is relevant as far as qualified distribution and penalties, but you can take in-kind distribution from your IRA LLC. You can do it all at once. You can spread it over a period of 5 years. You can certainly do that. The trick is that you're going to have to, assuming you're going to pull 20% of the property value each year. So in the year one, then the property you pull 20,000, you will have to do an appraisal on the property because this is a taxable event, and you will need independent third-party valuation to determine the taxable amount for that distribution. And then you'll have to retitle the property. So 20% will be owned by you personally, and then 80% will remain in your IRA. Then next year you will do another 20%. You have to do an appraisal again, and then retitle the property again to change the ownership percentage. And even though that you own portion of the property still remains to be in your IRA. So the prohibited transaction rules still apply. So you still can't use the property. You can't do any work on the property yourself. So it's a little bit tricky to do that versus doing it at once, which is most common, but it's certainly doable. If you plan for it properly, certainly this can be done.
Next question is from David. The advantage of checkbook IRA over self-directed IRA.
Well, a checkbook IRA is basically an IRA, a self-directed IRA on steroids, okay? They want to have a self-directed IRA on steroids, then checkbook IRA will enable you to do that. And there is a couple of ways to do that. You can do it through an LLC or you can do it through a trust. And essentially, you're creating a special purpose LLC or a trust inside of an IRA, and then your IRA invests in that LLC. You become a manager of the LLC. As a manager of the LLC, you control it. But your IRA buys 100% of the LLC units, and then subsequently, then you get to control that and you get to invest those funds. The main advantage is that you're now able to bypass the custodian, because if you have a custodial IRA, you have to go through the custodian for each transaction, each investments that you do. You don't have direct control over your funds. You have to, if there's an expense bill you need to pay, you have to submit a request to the custodian. They'll take some time to process that, and then they'll send the payment and they'll charge you a fee for doing so. So there are delays and there are extra fees to do so. You can eliminate that or bypass the custodian, as I said earlier, by utilizing the checkbook IRA. And so overall, it gives you total control and it minimizes your fees.
Next question is from Coulter. What are the kind of investment options out there for 401k funds?
I don't think I'm going to be able to list all of the investment options. With the self-directed solo 401k or an IRA, you have virtually unlimited investment options, okay? And IRS doesn't give you a list. And if you hear from somebody who says, well, this is a IRS approved investments, that's not true, because IRS does not approve any investments. IRS actually gives you a list of things that you cannot do, and those are prohibited transaction rules. There's 2 investments that you cannot invest with your IRA, and that is collectibles and life insurance contracts. And on top of that is prohibited transaction, which, as I explained earlier, they happen when disqualified person is involved. So you want to make sure that all transactions of your IRA or 401k arm's length, meaning that no disqualified person is involved. But again, you can invest in virtually anything with your 401k. And if you have a particular investment in mind and you're not sure, again, reach out and ask, and we can then I can give you more different answer.
Next question is from Brian. How to add money to my 401k from my W-2 job? How much can I add?
Again, the question a little bit unclear. Brian, I'm assuming you're talking about a 401k at your, or maybe you're talking about your solo 401k if you have a solo 401k and you have a job. Well, if your W-2 job offers 401k, then you can contribute to that 401k. And again, the limit is 22.5, but you want to talk to your 401k plan administrator. But if you're asking about making contribution to your solo 401k from a W-2 job, then you can do that. You can contribute to a solo 401k only from the self-employed earnings. So you have, first of all, you have to have a business or self-employment activity to qualify for one, and contributions to that will be based on your profit from the self-employment activity.
Next question is from Pamela. Do you have to file the necessary tax form if your solo 401k asset is not at $250,000?
Pamela, as I mentioned earlier, you're not required to do so. If your assets are below 250, you're not required to submit Form 5500 EZ, but we do recommend you do so. It's a good practice, but you're not required.
Robert's asking, at what point throughout the year are properties to be valued for calculating the 5500 EZ?
Robert, 5500 EZ ask, and if you look at it, you'll see there's a question and there's a column that asks, what is the total plan assets as of 12/31? So that's the date that you have to again, value all of the investments in your 401k, add them all up together, and then that's the number that you will put into that box as of end of the year, 12/31. Now, a little bit expand on that. That's not common, but it may happen if your plan has a different plan year. For example, if your plan year might end in March or maybe in October, then that will be different. So you'll have to use that date, but that's uncommon. And if your plan has that, then you probably know about this.
Okay, Handie's asking, why did I receive a 1099 from my previous company? Do I need to take any action?
I'm assuming previous company you're talking about the custodian that sent you 1099-R when you did the rollover of those funds into your self-directed solo 401k or an IRA. The custodian is required to report this, but there are different codes used on the 1099-R, and you want to look at that. I think it's box 7, if I'm not mistaken. There's a special code, and you can look up what those code means. And if you process this direct rollover correctly per our instructions, then the code that will be reported there as a direct rollover, and that's not a taxable event. And you can actually see it on the form. The 1099-R form will have the taxable amount. So it will have the amount of the distribution that, again, the custodian is required to report how much money went out of the IRA that you had there. And then there will be another box showing taxable event. So if you've done it correctly, the taxable amount should be 0. So you've got nothing to worry about. But also to add, you still need to give this 1099-R to your CPA. It still needs to be reflected on your taxes for records, but you don't have to worry about this. It's not a taxable event again.
Next question is from Sandy. Are there any more liquid options for which the solo 401k is eligible?
I'm not sure I understand this question. Are you talking about liquid investment options? Because generally, alternative investments, they don't have, liquidity generally. If you buy a real estate property, it's not liquid. You can just, sell it tomorrow, typically, like you can sell stocks or mutual funds. So again, you can still use conventional investment stocks and mutual funds. They're liquid. You open a brokerage account, you buy some mutual funds today, you can sell them anytime. But Sandy, feel free to reach out to me directly and clarify your question, and we can chat about that.
This question is from Joseph. I would like to ask about maintaining eligibility for my solo 401k when hiring staff.
Well, Joseph, solo 401k designed for business owners and their spouse only, and if you have employees, then you can only allow to have part-time employees. With recent changes, you want to keep that number under 500 hours. So if you have employees who over that limit, then you will not be eligible for solo 401k and you will have to shut it down. But no employees, good. Part-time employees under 500, you're still good. Over that, reach out and let's talk.
Next question is from Nancy. Adding my solo 401k to my trust using beneficiaries to increase FDIC insurance.
I'm not sure. Again, I understand the question, Nancy. The trust, are you talking about a family living trust that's used for the estate purposes? If you want to increase the FDIC insurance, it has nothing to do with the beneficiaries or the trust. What you want to do is, again, if you have more than $250,000, then you want to split that into multiple accounts.
Paul is asking, what are the requirements for maintaining a solo 401k?
Well, Paul, the requirements is that you have to maintain self-employment activity or a business and no full-time employees. So it's pretty simple. And it can be a full-time business, can be something that you do on the side. I have clients who they had a full-time business or been self-employed and they got a job, W-2 employment, but they still do something on the side, and that enables them to continue solo 401k.
Well, our Q&A session comes to an end, and we are very glad that you were all able to join us today. Thank you for those who sent in your questions. If you have additional questions, I see that there are some in the chat, but you are free to sign up for our next Q&A session and submit your question there when you register. We would love to answer it. It's going to be on Monday, March 27th at 11 a.m., so less than 2 weeks away. We also have another webinar coming up. It's on March 29th at 12:30 p.m. We will have Amanda Hahn and Mac McFarland joining us from Keystone CPA. They're going to be covering real estate tax strategies to supercharge your wealth building. So once again, we hope to see you at our next Q&A session and webinars, and hope you all have a wonderful day.
Well, guys, thank you for joining us. Lots of great questions. I'm sorry we were not able to get to all of them, but we'll push the next questions to, the remaining questions to the next session. I hope you enjoyed this. Like for me personally, I know that I often learn from other people's questions. So even if you didn't ask a question, or even if you did question, I'm sure you learned something from other people's questions. And if you know someone who can benefit from this, share this resource. We are recording it, so there's going to be we're going to post it on YouTube. Share it with other people that can benefit from it. Like this video so that other people or more people can learn from it. Subscribe to our YouTube channel so that you can notified of additional content. And feel free to reach out to me directly for specific questions that you want to discuss, and we look forward to seeing you again.